Hi, can you hear me?
Good morning, Michael. Yes,
Hi,
I hear you.
hi. Thank you so much for coming. Thank you. Really appreciate it. Thank you.
Oh, thank you for your service. Thanks
Oh,
for what you're doing.
you're really kind, man. You're really kind. Thank you so much. Um, I, I, I think I've got something really good today. I'm quite excited about this one. So I'll just give it a couple of minutes, basically, for people to kind of log in and stuff like that. Um, but yeah, I mean, in times when we're kind of going through right now, which is, you know, kind of markets a bit more shaky and stuff like that. I think it's kind of good to try and refocus on, what you're trying to accomplish and what you're trying to do. Um, so I kind of, you know, there are times when there's a lot of investment appetite and people are kind of chasing all kinds of things. And there are times when, um, things kind of lull in the market and it's difficult, but I like to read these kind of books about investing, and everyone says, "Oh, if you invested in X, Y, Z over, you picked that stock and you would have been like done really well." But I also, at the same time, I can kind of head out to the gym most days, and I pass these. I live in London, so some of these places in London, they've been around for like 50, 60 years. These little shops, and I think myself, "Wow, man! Like that shop has probably not had to have a lot of investment in it, and it just kind of keeps spewing out some earnings." And that's really the context of what I want to talk about today. I kind of want to talk about 5 indicators that I believe a person should think about when investing. A lot of people talk about these different indicators, and you know they're useful. The reason why the companies put out those indicators is to signal to somebody, okay, this is our story. Okay, this is how they try and explain their story. And um, the management, the CEO and his team or her team, the job is to get people to understand their vision. And we as investors, we have these kind of indicators that help us to relate company A to company B. And I'm gonna go through a few of these that I think people talk about. And what inspired me writing this was someone wrote in the post, "Oh, it feels like sometimes there are so many different, there's so much different terminology out there that it feels like you're picking up another language when it comes to investing." And I, yeah, I definitely relate because there's so many different things, and it's like, what is the right one? So I'm gonna kind of jump to the end here and say that there is no kind of magic ingredient. You know, it's a lot to do with understanding the context, okay? But as we go through each one of these, and what's important here is for a person to have some level of some kind of analytical thinking. Okay, so yes, those indicators guide you, but it's important to think about the context. So the first one that I want to talk about is total addressable market. And a lot of people say, or they write to me and say, "Oh, what's this company's total addressable market?" People say TAM. What is this? What is the company's TAM? And the problem with looking at a company's TAM is that it can be quite skewed. Okay, so the first one that I've tried whenever possible in this that we're going to talk about today, whenever possible, we're going to go back and talk about a particular company so that someone's interested, they kind of can look at this. So it feels more real if a person says, "Oh, this is the company we're talking about for this example," and it kind of helps to really frame it up. So the first one, the problem with the TAM is that it doesn't really, people can put all kinds of numbers. That's the first problem. It has these kind of unrealistic expectations. And the second one is that it doesn't talk about how competitive it is. So, I've never done an MBA, but, at MBAs, they always say, oh, as part of your case study, design a business that can get $1 billion in revenues. And people often joke, oh, I'm going to sell toothbrushes for $1 in China. There's 1 billion people, they buy one toothbrush each, there's $1 billion business. But that doesn't describe just how competitive it can be. There's so many different competitors that is kind of different. What differentiates one toothbrush from another? Is it just competing on price, or is there something else? So I was looking through, and I kind of went through my notes, and I looked up, and I'm going to write this Friday. So in 2020, Uber had an investor presentation day, so in December 2020, and they talk about their TAM as 3 different TAMs, which is the mobility TAM, which is the main thing, delivery and freight. Okay, so each one of these, they talk about having approximately $3 to $5 trillion TAM. Now, $1 trillion is absolutely ginormous, and that's for each one of those. Now, they just counted absolutely everything here in that TAM, but people are already getting service somehow, some way. Their ability to get, even let's say 2% of the TAM is really challenging. And I can say in hindsight that 3 years on, pretty much since that investor day, and the market cap is still at approximately 100 billion. So it's easy to come up with a spreadsheet and say, okay, this is what we think we can grow our business to. But in each case that we kind of go through, I think it's quite helpful to take a step back and think, okay, what's realistic here? So I think that this is one thing that people talk about. One financial metric is the TAM. Okay, going to talk about the other one. So this is something that actually it's a combination of what you told me, George, and what the person said. They wanted to know, I often talk about like free cash flow a lot, and so when you talk about a company's profitability, like where does it start? The profitability is a company's profitability the cost of after the cost of actually running those revenues. So if a business, let's say, is a software business, the cost of those revenues is actually really small. So they have very high gross margins. And the idea that growth investors have, and it has worked in some instances that leads someone to believe that this could work, is that once you have an entrenched business, for example, a software as a service business, which is already servicing those customers, you don't need to reacquire those customers. But I believe, from my experience, that this is a deluded premise, because the problem with technology is it consistently being innovated. And even I was looking at Dropbox, this is a business that, you already acquire a customer, they already ship out all the content to your infrastructure, to your service, and you don't need to reacquire them every time. But there's a new technology. Maybe the person wants a better e-signature. So it doesn't make sense to be stuck with Dropbox. They may be stuck with, they may move on to someone else. Maybe they go on to Google Cloud or some other free alternative. So just because you have the customer today, you need to entice them with good technology to retain them. So when you think about what is a profit, I talk a lot about in terms of free cash flow. Now, the free cash flow is an important thing to think about. So the way to think about it is, if a business, let's say just a simple business, has $1 in revenues, and after all the costs have come out, it ends up with, for example, 10 cents of cash flows, but then they need to keep investing in that business 5 cents, then you end up with 5 cents of free cash flow. Now, that 5 cents of free cash flow is a 5% free cash flow margin. Now, some businesses would say, 5% free cash flow margin, I'm not going to chase that. For example, if you say to someone like Apple or Microsoft, like if they found a new way of driving their revenues, they would only bring in 5% free cash flow margin, they wouldn't touch it. It would just be watering down their margin. They wouldn't bother with it. And then the other side of the example, you have something like Walmart or Costco that would die for a 5% free cash flow margin because they have a much lower free cash flow margin. And on that example, something like Costco, that is their competitive advantage, because no one's going to it's difficult to undercut. It's not impossible. It is quite difficult to undercut that. So, because they have massive economies of scale. So in business, what works for one example doesn't necessarily work for another example. And in of itself, each one can create a niche around their offerings simply because no one else wants to do it. The classic example is nobody really wants to go and open a mine. If you go to university or whatever and you go and study, you want to go and work, in a tech business or something like that, something that you can go back and be proud to your parents and your family and your friends. You don't really want to go and open a mine in Chile. You're like why would I bother? So that becomes, in a sense, like with the lithium miners and other miners, really, it becomes some kind of competitive advantage because it's quite difficult to open a new mine. It takes a lot of capital. You have to forecast that it's going to be profitable because otherwise no one's going to lend you that capital. The regulation has to be in place. And even if the regulation is in place, there's plenty of people who say, not in my backyard. So it becomes in and of itself. And it doesn't even have to be like something in Chile. It can be just another example is no one wants to make a waste business where you're basically just collecting people's garbage. No one really wants to do that because it's like, oh God, I don't want to touch that. And so these things become of themselves some kind of niche that there is very little competition for that. Okay, so anyway, I kind of digressed a little bit, but for me, I find it quite important to think about the gross margin of the business. Now, a lot of people believe that once the business is entrenched, you can cut back on the sales and marketing and cut back on the management teams that stay there, and you're going to end up with a more profitable business. Now, what management would want to fire itself? No management wants to fire themselves, right? The definition of the management is they want to stay in the company and they will do whatever it takes to remain in that position. So this idea that, oh, yes, we have a high gross margin, but we are unprofitable today, but we're going to be profitable in the future is nonsensical because it defeats the purpose. Like, it just doesn't make sense. So it often makes sense to think about a business's gross margins in terms of the quality of the business, but you have to be attentive. And you have to think about the fact that the companies know that investors value high gross margin business. So in the example that I'm providing here, I'm looking at Skillz, the business Skillz, and I'm going to write this up, but you can see with Skillz that they recognize that investors will, myself included, were attracted to this high gross margin business, and they were taking all their costs below that kind of gross profit line. So we had the illusion of being a high gross margin business, but is substantially unprofitable. So I will talk about a different business. So software is a business that some of you might know. It kind of a little bit competes with AppLovin. So it's not quite the same, but essentially they're about making apps, and they have two different segments, a bit like AppLovin in a sense, but they have two different segments where one of them is to give the tools to the developers to monetize their content. It's kind of a little bit overlaps a little bit with AppLovin. And so they always say, oh, look at our free cash flow, it's growing. But the reason why it's growing is because they have quite a lot of amortization of intangibles. So they acquire the company, and then they had to write off part of that acquisition. Now, that writing off of that acquisition is saying, okay, we may have overpaid, and there may not be as much value as we originally perceived there was in the business. And by them writing off that, it causes in GAAP accounting a reduction in their profitability. So there's a GAAP impairment. Now, on the free cash flow business, on the free cash flow statement, that figure gets added back. But the problem with the amortization of these intangibles is because that cash goes out the door in the first place. You goes out the door to acquire a company, and then after you've acquired it, over time, you amortize that. Now it's saying, okay, we overpaid. It's less than we thought it was, but that just means that next year or in the next period, they're going to have to find capital to put back into that business to make it back to what they thought they were getting. So the amortization of intangibles, or the amortization or the depreciation of the business, is money that goes out the door in the first place, and then its useful life is reduced over time. So I'm making it sound really complicated, but it's really not that complicated. So in a business where you kind of having to buy a lot of servers, those servers can last, let's say, 5 years. So it will be amortized a little bit each year, but that amortization can change. So for example, let's say that the technology withers away quite quickly, it may only last 3 years. So you're having to amortize that quite more aggressively, but the free cash flow would still look quite good because they're not having at this point yet having to put more cash back into the business. But that server has depreciated, so by year 4, they will have to put some more capex into that business. So it's just delaying the inevitable. So when you look at a business that has a lot of free cash flow, just have a think about, sometimes you can read on the earnings call, but just have a think about what they're actually trying to do there. What is the actual fundamental that you can touch, free cash flow that you can take out of the business. So a lot of businesses talk about having they talk about, oh, look at our high adjusted EBITDA. But it's important to look through that EBITDA and see, okay, what percentage of that is just amortization of intangibles, and what percentage of that is stock-based compensation. If it happens to be the case that 100% of the EBITDA is stock-based compensation and amortization of intangibles, it just means that there is no real cash in the business. It's just a pretend cash. So it's important. You don't need to spend a lot of time with this. You can just get familiar with the companies, how they report stuff, and they don't change typically a lot. There are some companies that are consistently showing higher EBITDA than you may believe they have. But these guys are consistent, so you kind of know. You don't need to do it every single quarter, and it may sound quite difficult, but once you kind of get familiar with it, it's like I said previously about the balance sheet. Just spend a couple of minutes. Once you just look at these things, you don't need to do it like every single day. You just, when the results come out, just look, okay, what percentage of the business's EBITDA is just amortization or stock-based compensation? Okay, moving on. So about the moats. So I wanted to just complete that thing that we were talking about before, that how do you figure out if a business has a moat? So the way that I try to kind of think about it and to explain is, whenever possible, look at a company's customer adoption curve. Now, the customer adoption curve works in certain instances, okay? And I'm going to tell you when it doesn't work. So the customer adoption curve, I believe, is often more reflective of the business's health than the revenue growth line. Because revenues can jump up quite quickly, but it can also come down quite quickly. But if you have a period, for example, Netflix, okay, so the subscriber numbers are consistently going up and up and up and up. Yes, they may be slowing down, but that number kind of is more steady than the revenue growth rate. The revenue growth rate, you may have that they kind of increase the pricing, or there was a bit of a weakness in the economy. But if you have, let's say, I don't know, just for round numbers, 180 million subscribers, that's a lot of value there. So it's quite difficult to replicate the value of that Netflix has. Now, people can complain that, for example, oh, Netflix hasn't got really good content. Now, people are creatures of habit. And you can see this in the energy transition. Everyone talks about the energy transition. I talk about it. I'm guilty. I always talk about the energy transition. But you can see that for all intents and purposes, we are still very much an oil economy. They talk about the energy transition. So in the year 2000s, globally, the amount of energy that we came from fossil fuels was 86%. And in 2022, last year, it was 83%. So it went from 86 to 83 over that 20-odd year period. So people talk about, oh, we're transitioning. We're always transitioning from something to something, right? We used to use burning wood, and then we kind of started to use coal, and then after coal, we started using diesel engines, and after diesel, like natural gas. And, you know, we're always moving from something to something, but things take a long time to move, and we are creatures of habits. Now, going back to that Netflix example, a person can be often tricked into thinking stuff when the share price is kind of moving around a lot. But I believe the best way to tell about a company's moat is looking at a customer adoption curve. Okay. Now, when does that not work? Okay. So I kind of tried to go through an example in my mind when I found that there was a business that had a lot of customer adoption curve in a short period of time, and then it just faded into nothing. And I had to rack at my brain for a little bit here. So I came up with Groupon. So Groupon used to sell these kind of coupons online where you can get discounts on stuff. And it became quite a fad, and everyone was kind of using it and logging in. And for a while, they had massive customer adoption curve. But then, you know, it just kind of, people got bored, the consumer habits changed, and it kind of fizzled out. So in that example, you would have been just looking at the customer adoption curve, and it would not have worked out. So what I'm trying to say here is that it's important to just have a bit of thinking in your mind. Okay, what really makes sense? And then my final number 5 that I'm going to talk about, people often ask me, what kind of multiple on a stock makes sense? Okay, so the multiple is just a short way of saying the price to something. Okay, so certain businesses, for example, banking business or an insurance business, you may look at a price to book. Okay, in a different type of business, for example, a low growth business, I think it's wiser to look at a price to free cash flow. In a business that's growing quite rapidly, it may be at this time that the business is growing, let's say, at north of 25% year over year. It's not going to grow at that level for a very long period of time. So in those few years that it's growing at very high rates, above 25%, they need to outdistance themselves from the competition as aggressively as possible. And the way to do that is to invest in their business as aggressively as possible. As a consequence of that, they're not really being managed to be as profitable as possible right now. They could, once they've established their position, somewhat increase their profitability, but there's a limit. That's what I discussed at the start when I talked about that management is never going to cut out their own compensation, right? So they'll kind of wiggle around and, you know, ultimately probably get sacked or whatever. But the idea here is that if the business is growing at a reasonable rate, above 25%, they should not be maximizing profitability. They will have time to maximize that, but it's important to realize different multiples work in different instances. Now, I don't think that just because one stock in the sector is relatively cheaper than its peers, that necessarily means it's undervalued. But it's important to compare just roughly what the multiples are the people are paying for the sector as a whole. Okay, so for example, if you're looking at a SaaS business, a software business, they're probably paying, let's say, 5-8 times forward sales, kind of roundabout that. It very much depends on where interest rates are, and interest rates have a very big change to this. I went to Tom Gaynor's from Markel. Tom Gaynor is the CEO of Markel. He had an investor day here in London, and he talks about this example, which I really like this example. It's a bit complicated, so bear with me because I never really actually retold it to anyone. But he says that interest rates are very much like a curfew when you're young. So they work inversely to each other. So if you're young and you kind of go out and you're like 18 years old and you come back in by 6 p.m., nothing bad's going to happen to you. And that's the same as when interest rates are quite high, let's say around 10%. And then if the curfew comes down, that means like the interest rates come down to, let's say, 4%, and you're able to stay up till 10, you can go out, you hang out with your friends, maybe you have a drink, you come back, if you're European, you have a drink. I mean, if you're American, you might not have a drink, but whatever. And if interest rates come down to, let's say, 2%, and you're able to stay up until midnight, then there's more likelihood that you're going to do something that you shouldn't do. So when Tom Gaynor talks about this impact of interest rate, this goes back to the multiples. So the multiples can change over time relative to where interest rates are. But it's important to always ground yourself and think that we just went through a decade that was quite abnormal, where interest rates were quite low. That is not the status quo. And we are now entering a more normalized period where interest rates are more normal, and there has to be a readjustment in people's expectations. And for businesses, it's going to be quite difficult for them to borrow and invest in their growth when interest rates are higher. So the multiples that you're going to pay will compress because they're not going to be able to grow as aggressively. So whether you're looking at the price of sales or price to free cash flow or whatever, have some kind of gauge of what investors are paying for their competitors. But don't be put in the opinion that just because your stock looks cheaper than the competitors, that means it's a bargain. It could be, but just have a bit of just have a little bit of feel for it. Now, just to conclude everything here, everything that I'm saying is about adding some kind of shortcuts to thinking through this. So everything that I'm trying to do is about simplifying the story of investing. Everything that you do, try not to overcomplicate it, because when it becomes too complex, you have no way of seeing whether the company is flowing in the right direction, because you are looking at this, looking at that. And so just try and kind of just bring it down to like a couple of things that you're looking at for a business to perform. And yeah, that's my little spiel. I hope that was helpful.
Thank you.
Thank you. Would anyone like to ask any questions or anything? I know I went on for a very long time today. Oh, thank you. Someone just said something. That's really kind. Thank you. Yeah, I mean, this is, I've got a couple of minutes here. Like, if anyone has any questions, otherwise I'll kind of talk about something else.
Michael, one quick question. This is Prince. Sorry, my camera is not on.
No, don't worry. It's fine.
Any thoughts you have, like you keep listening about this type of ETF, that ETF, but in general, my approach has been, they charge the expense fees, and you wonder, like, just a bag of stocks which you can independently own anyways. So I was just wondering, from someone of your mind, what do you think about ETF when it comes when you hear investing in them as opposed to investing in individual stocks, which you recommend, I suppose?
Yeah, that's a really good question. Thank you for asking it. Welcome. So it's all about your, I always say, try and know who you are before you invest. There's a quote that if you don't know who you are, this is an expensive place to find out. I prefer to invest in companies because that appeals to me and my personality. And I always say to everyone, like, know who you are, okay? And if you have very little time, just buy something like the S&P 500. I think that's really, really something that's going to do quite well for very, very little effort. I try my best to work hard, and I try my best to find businesses that I enjoy being part of their story, because when I go, I believe that if you think like the owner of the business, you're more compelled to do some research and understand, understand what's really happening here. Look at their competitors, look at the sector. But you're asking about like on ETFs and the expense fees. So typically, coming from that question, I would say something like the Vanguard S&P 500 has like the least fees. It's something that Warren Buffett recommends also. And I think that that's absolutely fine. And what I said to George last week or the week before, if you want to kind of pick individual stocks that you want to do, just put aside, let's say, 5% of your portfolio and do that, scratch that itch and keep that 95% in the ETF. And the advantage of putting that 5% is two things. First, if you lose it, you're not going to die. Very important lesson. Second thing is that 5%, I personally see it as you investing in yourself. The way I see it is that if you're trying to understand, I was looking today at Arch Resources, and I, like it's a dividend stock that I own, and I'm like thinking myself, I'm trying to understand about this. They do met coal, which is basically used to make steel, and I'm trying to understand like what are the drivers here, and you grow as a person by doing that research. But you may be at a point in your life where you don't want to do that because you have family, kids, whatever, and you say, okay, no, at this moment in time, I don't want to like invest in myself, and I'm quite happy to just buy the ETF. That's absolutely fine. But you may say, okay, you know what? I don't need to go 8 or 80. I can kind of just learn about one or two companies, and you learn a lot. It's an opportunity to learn. And the way I say it is that the more that you invest, these lessons become part of your knowledge. So the point of life is, I think, I don't know, but the point of life is for you to kind of grow and mature as a person and see things from different perspectives. And that knowledge that you're picking up, it never goes. You keep learning and you keep learning, and it becomes for example, a business case or a study of things that you've learned, and that's part of your growth as a person. And I find that quite enjoyable, and you need to know if that's enjoyable for you. Yeah.
No, thank you very much. Thank you. Helpful. Yeah.
Does anyone else have any other questions? No. Okay, guys, thank you so much. I talked a lot today. Really appreciate you guys coming along. Drop me a line anytime, like George, I know you drop me lines all the time, and Prince, be welcome to drop me a line. T-Moss, if you like. Yeah, I mean, you guys are the people that really, when you write me these questions, what formulate me to come here on Tuesday and try and answer that, because I sometimes have different ideas and I'm very passionate about certain things, but like, I don't know what is interesting to other people. And when I do these, when I prepare for this, I prepare for these talks over the weekend, I kind of think myself, okay, like what is the most value I can provide to somebody else, so that because I've picked up quite a lot of experience over time about investing. I've looked at a lot of stocks and stuff like that, and I've seen a bit of what works, what doesn't, and that experience, it's a pleasure to have been through it, but it's also nice to share it and explain to people how, like, don't make that mistake. I've been there, I've made that mistake, don't make that mistake. It's quite a pleasure to, when you guys reach out and kind of say, okay, like, what is this, what is that, and I kind of, no question is too small. Okay, thank you so much, everyone. Really appreciate everyone coming. and I'll see you next
Thank you,
week.
Michael.
Thank you so much.
Thank you. Thank you.
Take care.
Thank you, Michael.
Thank you so much.